Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Stanley Druckenmiller is a legendary multi-billion-dollar investor and former hedge fund manager. Just a few days ago, he openly described what he thinks is the next phase of the economy, and he's not sharing his opinion for fun. He is basically telling you how the most plugged-in money on the planet is positioning, and not because they're always right, but because they're always early, and being early is where money actually gets made. And if you don't know who this man is, he isn't just some rich investor. He has access to global elites, even the White House. In fact, this is the man who partnered with George Soros, who's known as the man who broke the Bank of England as a result of a short sale in 1992. Stanley Druckenmiller might as well be in the White House himself. The core idea is going to be simple for this video. The Federal Reserve may not hike rates and could even cut rates, and that combination matters a lot. Because when money becomes easier to borrow, when rates come down, and when the system gets flooded with liquidity or incentives, assets tend to inflate. That includes stocks, real estate, commodities, and anything tied to future growth. And if you're hearing that and you're thinking, okay, so the rich just keep getting richer, you're not wrong, but you're also missing the bigger picture. Because when these cycles hit, regular people can absolutely ride them too. The difference is that the rich and powerful position early and stay calm, while regular people wait for confirmation, they panic at the first pullback, and then buy late when it already feels safe. My goal in this video is to explain macroeconomics, which is something that we don't talk about that much on this channel, but it is very important because this can be a very golden opportunity, and regular people can make a lot of life-changing wealth if they play it smart. So without further ado, let's get right into the video. So here's what was basically said in this interview with Stanley Druckenmiller and Morgan Stanley. Stanley stated the economy is strong and it could get stronger, especially if a large fiscal package or a stimulus-like spending shows up. At the same time, the Fed is more likely to cut than a hike, and if the Fed cuts, that tends to be more fuel for assets. But there's a twist. The stock market is not cheap. Valuations are high compared to historical data, meaning a lot of future success is already priced in. That makes traditional indexes feel a little more complicated in the short term because when prices are already high, the market can become extremely sensitive. So even great earnings can still lead to falling stock prices, as you've probably seen with stocks like Nvidia. If expectations were even higher, one bad headline would erase months of gains. So the question is, what does smart money do when it thinks the economy might stay strong, rates might come down, but stocks are still pricey? It starts looking for the next best place to be. It starts looking for assets that have real demand, a tight supply, and a structural story behind them. In this case, Stanley points at industrial metals like copper. Think about gold as an uncertainty hedge, and also think about positioning that benefits from growth, infrastructure, electrification, data centers, and the AI buildouts. Now, I want you to notice something. None of this is a secret. It's not a mystery. It's literally just supply and demand, plus policy and some psychology. And the golden opportunity for regular people like you and me is not trying to predict the next big thing. The opportunity is understanding the direction that money flows. That way you stop swimming against it. Normally, if the economy is booming, the Fed would be cautious about cutting rates because it could create inflation. Lower rates encourages borrowing. Borrowing increases spending and investment. Spending increases demand. And if demand will rise faster than supply, prices rise. That is inflation basically summed up in one sentence. So then why would cutting rates even be on the table? Because there is an argument that technology, specifically AI and productivity tools, could increase productivity so much that it has a deflationary effect. In other words, the economy can produce more output without needing as many additional inputs. So basically, companies can generate more revenue without expanding payrolls at the same rate, so they can scale faster without the same cost structure. Now, if this plays out, you get a strange but powerful mix. Growth would stay strong, but inflation would be contained. If inflation does stay contained, rates can actually fall. If rates fall, asset prices often rise, and if asset prices rise, people who position early can get paid. That is how you create the wealth. That's why people call certain periods like this the wealth building era, because it's policy, productivity, and positioning that can actually make you wealthy. But this is also the part where regular people usually miss out. They wait until everyone else has already agreed on something, and by the time everyone agrees, The prices have already moved and there is no more value. So now let's address the elephant in the room. If stocks are expensive, does that mean that you should avoid them completely? Well, not necessarily. What it does mean is that you need to stop thinking in black and white. You don't need an all-in or all-out strategy. You just need to be an intelligent investor when it comes to this. When valuations are high, markets can still go higher, but the ride is a little bumpy. And it becomes less about everything goes up together and more about selectivity. It becomes more about quality companies with real cash flow and realistic expectations. It also becomes more about not overpaying for hype, and it becomes more about understanding that the market can punish even good companies if the price was too optimistic. And this is where regular people can still win, but only if they stop acting like every market dip is either the end of the world or the deal of a lifetime. The golden opportunity is learning how to stay consistent while everyone else gets emotional. Now, we do have to get into the part that sounds scary, but it's actually crucial to understand because it changes how you protect yourself. There is a growing concern that AI investments in automation could reduce demand for certain types of labor. We've talked about this, and honestly, it's just unavoidable. And this is not in like a sci-fi way where like robots take over everyone's job overnight, but it's in a very practical way where companies start cutting headcount early just because they believe that AI will handle more tasks. This can also happen because they fear competitors will actually cut faster and become leaner. And here's the part you guys should really pay attention to. Markets often reward layoffs. So a company will announce a big cut, and then the stock actually pops because investors think that margins will improve. That creates a perverse incentive. So executives see that cutting payroll can actually boost stock performance in the short run, and suddenly layoffs become a strategy and not just a last resort. And this is going on right now. US employers announced 108,435 job cuts in January of 2026. This is the highest total for any January since 2009, and this 118% year-over-year increase indicates a significant surge in layoffs. In fact, Jack Dorsey, the former owner of Twitter and current CEO of Block, which is formerly known as Square, just announced that he's laying off 40% of his workforce because of AI. And he sees similar companies doing the same thing next year. So when this was announced, Block stock actually jumped up by 20%. Now zoom out and think about that economic chain reaction. If people lose jobs or fear losing jobs, they spend less. If consumers spend less, then companies see slower demand. If demand slows, companies protect profits by cutting costs further. If the easiest cost to cut is labor, more layoffs will happen. And then if layoffs will increase, demand can weaken more, and then that's the deflationary loop. This matters for everyday Americans because it changes everything. You're no longer just investing, you're also building personal resilience. And here's the good news. The people who build this resilience during the transitions are usually the ones that come out much wealthier. Because when the world is shifting, the average person will freeze, but the prepared person, they can reposition themselves. Now let's talk about that repositioning a little bit more because it will happen in 3 phases. First, the system injects fuel. Now that can be stimulus, it can be government spending, it can be infrastructure build-outs, incentives for domestic manufacturing, or a massive private investment like data centers and AI infrastructure. Money flows into real projects. Second, borrowing costs drop or at least stop rising. And when rates are not crushing the economy, capital can actually move, people can refinance. If you have businesses or you want to use business credit, you can actually invest and asset prices can breathe. And third, the world needs real things again. Physical inputs like energy, metals, industrial capacity, supply chains, and infrastructure. And that shift creates multi-year demand for certain sectors. When those 3 ingredients mix, you get trend-driven opportunities, not overnight lottery tickets, but waves. And waves are where the average person can actually win. Because you don't need perfect timing. You need participation plus patience. This is why assets like copper get so much attention. If supply is tight and demand expands from electrification and data center growth, the price pressure can last for years. And if you see that kind of multi-year setup early, you don't need to be a genius. You just need to not panic every time the charts wiggle a little bit. This is also why gold is getting so much attention, because gold can act as an insurance when geopolitical risk rise or when trust in institutions kind of feels a little bit shaky. Now, it's not about getting rich overnight, but it is about having a hedge when the world gets kind of weird, which is kind of going on right now. If you guys haven't noticed, the dollar is really, really weak. Now, let me be very clear. This is not financial advice. I am not a financial advisor. I'm just explaining how these cycles typically work so you can think about it clearly. If you're a regular person trying to actually turn this moment into a golden opportunity, then the strategy is not about being flashy. It's about being consistent and positioned. And that starts with getting your financial foundation strong, because opportunity is useless if the emergency wipes you out. And that means you need a buffer. You need to reduce high interest debt. You need to make sure that you can survive volatility, which is why I've been making so many videos about how to actually manage money, accounts that can actually grow your wealth, different ways to increase your income. I'm doing all of that for a reason, because credit alone is not going to actually build you wealth. You need to start building exposure to the trends that could benefit from this environment. If you believe productivity can rise while policies stay supportive, that's generally favorable for assets over time. If you believe that the AI build out is real, then pay attention to what AI actually requires, not just the companies with the coolest marketing. AI requires power, it requires chips, data centers, cooling grids, upgrades, and a mountain of raw material. That's where the regular person can actually show up. You're not trying to outsmart Wall Street. You're just trying to stop ignoring what's obvious. The obvious is that the world is rebuilding infrastructure for a brand new era, and that tends to create wealth for people who can actually get into this early and hold out through the messy times. The biggest mistake you can make is thinking you need certainty before you act. Certainty is expensive. The market changes, and you're going to pay a premium for certainty. By the time it feels obvious, by the time that everyone agrees, by the time that the group chat is talking about it, you already missed the opportunity. The second biggest mistake is chasing what already ran with no plan, no risk management, and no patience. This is how you turn opportunities into regret. And the third and final biggest mistake is doing nothing, because the world feels complicated. Complexity is not a reason to just do nothing. Complexity is a reason to simplify the process and focus on what matters. So start with building a stable foundation, stay consistent, and give yourself a real shot at the kind of wealth building that looks crazy in hindsight. So here's the takeaway. If the economy stays strong, if stimulus-like spending supports growth, and if the Fed eventually cuts or is dovish, we could be entering an environment where certain assets and sectors benefit for years. At the same time, if AI-driven productivity is real, it could keep inflation in check during growth, which would be rocket fuel for valuations in certain parts of the market. But again, there is risk. Labor market disruption is real, volatility is real, and markets that are priced high can be very unforgiving. So this is what I would say for the average person. Stay employed, try to stay liquid, stay disciplined, and then stay invested in the right trends while everyone else is distracted, emotional, or just frozen and does nothing. If you do that, you don't need to hit a home run. You just need to be in the field when the game starts to change. And that's how a regular person quietly becomes the one that everyone calls lucky later on. I want to thank you guys so much for watching this video. I really like talking about macroeconomics and things like this. I don't always get to do it on this channel, but if you want more like this, please drop macro in the comments. And if you would like me to make a part 2 video where I actually show you some investments that you can look at right now, then please put part 2 in the comments. Again, I'd be more than happy to do that for you. And this video is just usually thoughts that I would normally keep to myself, because I can't quite, always do these types of videos because of YouTube, the algorithm, and the way that it works when you're in a particular niche. But once again, if you guys really show love to this video, I can definitely take a strong step forward into making more content like this to actually talk about different ways that you can build wealth. As always, thank you so much for watching this video, and you guys have a wonderful day.